one of the other questions I had that's connected to this, Kunal, is whether there are certain type of strategies that you think are best suited for beginning traders.
Sure. So when you are new, the easiest things that I personally think to do is to follow trend following techniques. There's been a big fallacy, I think, of the last 6, 7 years, and a lot of just the advent of chat rooms and Twitter and stuff like that. Yes, the biggest reward plays and the biggest like kind of percentage plays that you're going to find is like say you short small caps, for example, right? You short these pump and dump type of names, and you'll do it, and you'll make all this damn money, right? You can grow your smaller account in big chunks, but then it only takes one to ruin yourself, right? So you never really get anywhere. So now that is a great technique if you are good and flexible and know when to use it. But you also have to know when to lay off. For example, like Nate is like the best at this specific technique. But even he will tell you, as I've known him, 2008, we used to chat on Gmail all the time about these kind of plays. He's made more money going long than he probably ever has short. But what he's known for and what he's actually made the money on, they're probably a little bit different, right? Because he's always had the ability to adapt. Where it's like, you know what? I'm not shorting these pigs right now because pigs fly, right? I'm longing them. So you may learn one specific pattern and you buy it at this spot. But you have to know when you actually are supposed to buy that and when that's the spot you short it, right? But most people won't know that. That takes a lot of experience and a lot of flexibility. So that's not the best pattern for new people. It's a great pattern, but it's not good for new people because you're faced with a decision that you're not supposed to have, which is this a long or short? If you don't know and you have to take a guess, that's not a good pattern for you, right? So trend following techniques is really a great pattern for new people because it is not, is this a long or short? It is just, hey, I'm following with this trend. So there can only be one way you can get into it. Now, whether you get in too high or too low, that's a whole different suspect of things. But you have to learn these trend following techniques because in the end, like the market's either trending up, trending down, or going sideways, right? And so following with the trends is the easiest way because you don't have to overthink this. You don't want to look at a stock and sit there and think, is this a long or a short, right? You want to look at a stock if it's trending and saying, this is a long based on the daily chart, based on the trend, based on the overall market. And now I am going to narrow down and look for an entry point to long this because I'm trading with the trend. And that becomes much easier because like, hey, like if you, for example, like a Tesla or Meta or NVIDIA this year, right? These are big, big uptrends. So you have this huge wind at your back. So now it's like, okay, I've just got to find a way to get into the waves of this, right? I just got to find a way to catch in to the flow of this and trade with the wind at my back. First, if you go the other way and you're looking at this both ways, then, it's like pissing in the wind, right? It's a great idea when you're with your buddies, you have a couple drinks and everybody's like, shh. But sometimes it flies back in your face and that's not cool. You got to always learn to go with the wind. And so I think that trend following techniques, if you're new, is the best way to go because bull market, bear market, whatever, you follow with that trend. Those are easier trades, but they're also the ones that are going to cause you the least amount of mental distress. Counter trend trading can be very profitable. Counter trend trading can be so profitable and it can have so much reward when you're doing these kind of mean reversion to the mean trades. But they are hard to time and they are tons of mental stress on you. When you're trying a reversion mean trade and you're going against it, you're sitting there. It's going to take all your will. It's going to take all your willpower. It's going to make you question the Lord himself sometimes when you're going counter trend. You're shorting it and it keeps going up, or it's going down and you're buying it and it keeps going down. It makes you question everything. And that's a lot harder of a trade. I think that it's the mental capacity of how much a stock is going to move when you go counter trend. It's a really hard trade. I do that kind of trade too. Hey, we all get into it. Like, right? We see something go like this CCL or something's like $10, goes to $20 in a few days. And you're like, this thing's a pig, right? Like, I got to short it. Yes, there's a time and place for it. But man, it's a lot of stress. Man, I was staring at this thing for the last few days. Like, I got to short this thing and take it off the list, right? Because it's going to take so many shots. It takes so much discipline that you have to be a really good trader to do it.
Those are excellent considerations for newer traders. Is it fair to say something like a mean reversion type trade is something best suited at a certain time and place and maybe a little bit more of a advanced type of strategy?
Sure. So it depends on market cycles. So there's 4 stages of the market, right? So you have accumulation phase, distribution phase, you have run up phase and run down phase. So run up phase, run down phase. This is your bull market, bear market. Distribution phase is like a topping out cycle when the market's at highs. And accumulation phase is that sideways basing when the market's near lows, where everything is negative, the news is negative, the world hates the market, but the market refuses to go down, right? So we were in accumulation phase, for example, tech stocks from the summer of last year up until right the beginning of this year. News is terrible, market looks terrible, economy looks terrible, right? But the market just flatlined for a long period of time. And so did all the stocks because they were down 80, 90%. So when you have that specific cycle, okay, all the stocks are going to start to rip even because the news is bad. Even when earnings are terrible, even when CPI, these things all come out, but like the market's not moving. It's near lows. It's not going up, but it's shrugging everything up. So during those phases of the market, it's telling you like, hey, a bullish cycle is coming. So now like you can do certain strategies, for example, like trading breakouts, right? Chasing stocks, right? You can chase if the market is hot. But if you do that when the market is in a distribution cycle where it's topping out, well, in a distribution cycle, guess what? If you chase breakouts, even if you buy it at the picture perfect spot, they're like not going to work. So like if you were looking at say if you looked at the NASDAQ, right, in end of 2021, the NASDAQ was topping out end of 2021 for the last few months. But every individual stock had already started to roll over. UPSD, Affirm, PayPal, Square, every single stock except Tesla, Apple, right? So the market was holding up, but every stock was drifting lower. So you were in a cycle of distribution. Big money was selling. So at that point, if you're, say, doing a breakout trade, guess what's going to happen? It's not going to work. But vice versa, say in the last few months, before in January, December, February of this year, when the market was still near lows, but start to inch higher because you're near lows after the market's retraced 30, 40%, all of a sudden the breakouts start to work because you're in a different cycle of the market where, hey, bad news is good news. But when the market's near top in those topping phases, good news is bad news. Things change. So you always have to be aware of these things. And that's what happens with the flexibility and adaptability to the markets. Most people, what's happened because of COVID is they have become so focused on individual stock setups. Hey, these are the things that are working. These are the things that are exploding. And so what's happened is there's been a lack of education in market structure. What are the general indices doing? What are market breadth characteristics, right? Number of stocks going up versus down. Number of stocks breaking out versus breaking down. What are the indexes doing? There's all these nitty gritty things that are happening inside the market that you have to be aware of. But when the market is raging, like in COVID times, those things are thrown out the window. And so you don't have to look at the market. Whether during COVID times, myself included. Hey, market gaps up, down, market's red, green, QQQ is doing this, that. Doesn't matter. Like everything is ripping, right? And so you're just looking at individual stocks and trading these things. And you almost forget that it's a rising tide that lifts all boats. When the market structure changes, all of a sudden your strategies have to change. But we got so used to being easy that we forgot that guess what? Easy is not always the case.